Hi everybody, this is James Tompkins and welcome to the fourth lecture of the Advanced Corporate Finance series. Now, let me just remind you exactly, if you will, the big picture of both of these series. Corporate finance was about the asset investment decision. What's an example of an asset investment decision? Well, for example, when Apple decided to invest in the iPhone. Basically, the asset investment decision, that's what a company spends its money on, okay? Some would argue this is the most important decision a firm makes. You could argue that the reason that Apple stock went up so much in the relatively long run, was it because of how they chose to raise money, or was it primarily, you think, because of the business that they got into, like iPhones and iMacs and this and that? Probably the business they got into, right? So corporate finance, this whole series was about the theory and practice of the asset investment decision. And in this next part, the advanced corporate finance series, that's about the financing or capital structure decision. Okay, so that's this side. So if I remind you on what finance means, well, how did you pay for your last car if you own a car? Well, you probably financed it, right? So finance means to raise money. So is the financing or capital structure decision, is that about, well, I wonder if I'll raise money or not? It's not, right? Because is it true that you have to raise money to spend your money on something? You do, right? So the financing or capital structure decision is not, I wonder if I'll raise money. Rather, it's given that I'll raise money. Well, how will I structure this capital? Will I have 40% debt and 60% equity? No debt, all equity? And so on and so forth. So in any case, as we look at this capital structure decision, in the first lecture on this topic, capital structure and perfect markets, we basically made two sets of assumptions. Do you remember what those were? Well, basically we said, hey, you know what? No matter how I choose to structure my capital, I'm going to invest my lemonade stand no matter what. In other words, the asset investment policy or asset investment decision, that was fixed. That was a given. And then what other set of assumptions do we make? Perfect market assumptions, right? And we said that, or Miller and Modigliani rather, they said, all right, assuming perfect markets, which assumes what? Do you remember? No taxes, no transaction costs, which includes bankruptcy costs and financial distress. I'll explain more about that later. And also no information asymmetries, which means that I know, for example, as much about IBM, i.e. me, the public, as, say, the CEO of IBM. And Miller and Modigliani showed that given those two sets of assumptions, so fixed asset investment decision and perfect markets, that capital structure was or was not an important decision. That it was not an important decision. Basically, it would not impact firm value, total firm value, and it would not impact stock price. So we saw how the world worked in this, or how the capital structure decision worked in this very unrealistic world. And so what it means is that if the capital structure decision does matter, then it must matter because of loosening, if you will, those restrictions that we put in with the assumptions. So in other words, maybe taxes drive the drive the capital structure decision. Or maybe the assumption about, hey, no matter what, I'm going to invest in my lemonade stand. Maybe that drives the capital structure decision, and so on and so forth. And so, therefore, as we proceed with today's lecture and also the lecture following this, we're going to start removing those assumptions one by one. And in this lecture right here, we're going to focus on taxes. How is it still true that the capital structure decision is not important when we add in corporate taxes? Is it still true that the capital structure decision is not important when we add in personal taxes? And then in the next lecture that follows this series, the agenda will continue and we'll look at some other issues that relate to capital structure. So what about bankruptcy costs, which is a type of transaction costs? And what about the assumption that, hey, no matter what, I'm going to invest in my lemonade stand? Okay, maybe capital structure choices are impacted by that. And what about information asymmetry? What's the relevance of that? And so on and so forth. So basically, the agenda today is going to be taxes, and in the next lecture, we look at other issues. Now, in general, we can think of a model, if you will, that the value of a firm with debt, and I'll stress that as VL, so value of a levered firm, you could think of it as the value that it would be without any benefits of debt. And then GL would be the benefits that debt provides, the gains of leverage. Okay, so if I'm going to draw, if I want to show you what I mean, okay, normally I'll say VL just to stress that it's a firm with debt. And I'm going to make up these numbers, okay? So normally you think of the value of the firm as being the sum of the market value of what? Well, debt and equity, right? Normally you just sum the market value of debt and equity and you get the value of the firm. It'd be 100, okay? But you could also think of the value of the firm as being, well, if there are any benefits of debt, maybe there are none, in which case this would be 0. But maybe there's $20 worth of benefits of debt. And then everything else would be the value of the firm without those benefits, or the unlevered value of the firm. Why do we call it unlevered? Because it's related to nothing to do with debt. So in any case, what we're going to be doing is we're going to be focusing on, well, what is GL? Okay, what are the benefits of debt? And as I mentioned, in this lecture, we'll be focusing on taxes in general. And we'll start off with corporate taxes. Okay? So here's a question. Does debt financing have an advantage over equity financing when considering corporate taxes? Well, when corporations pay interest, is that tax deductible? It is, right? And if it's tax deductible, does that mean they pay more taxes or fewer taxes? Fewer taxes, right? And so is that a benefit of debt? It is, right? You can see it right here in the income statement. Okay, so if a firm, I've just made up these numbers, if a firm has this number of sales and it's got various costs, etc., here's the earnings before interest and taxes, and then they get to deduct interest. Okay, so and because they get to deduct interest, do they now have a bigger tax bill or a smaller tax bill? A smaller tax bill, right? Now what about equity? Who does this net income belong to? That belongs to the shareholders, right? Why does it belong to the shareholders? Well, because the debt holders, they've already been paid. They've been paid their interest. Okay, so what's left over belongs to the shareholders. After everyone else has been paid, the last people to get any money, we call them the residual cash flow holders, okay, are the equity holders. Now, what are the only two things a firm can do with net income? Well, either they can pay it out in the form of dividends, or they can keep it, right? Now, either way, let's say if they pay it out in the form of dividends, well, is that tax deductible? It's not, right? And so therefore, at the corporate level, does debt have an advantage over equity when it comes to corporate taxes? It does, right? So what that means is that we could say that the value of the firm with debt is the value of the unlevered firm. Okay, so again, that's the value of the firm without any benefits of debt. And then what's called this debt tax shield, which is the present value of all the taxes that are saved due to paying out interest payments. I mean, if you think about the debt tax shield, what is a shield? What does a shield do? Protects you from something, right? And when you think about the debt tax shield, what do you think the shield is protecting you from? Taxes, right? And what is it that is protecting you from those taxes? Well, the fact that you have debt. And so you might save, say, $50. I'm making up that number. You might save $50 in one particular year of taxes because you have debt. All right? And you might save $50 the next year and $50 the year after. Well, the present value of everything that you expect to save in taxes is known as the debt tax yield. So what we'll do is we'll calculate this debt tax yield, okay? And I'll do it with numbers as well as with notation, okay? So imagine that D is the dollar debt amount, so say $100. RD is the interest rate, or the rate of return required by the debt holders. Let's say that's 10%. And then TC is the marginal corporate tax rate, say 40%. And I've just made up these numbers. And by the way, what's the difference between an average tax rate and a marginal tax rate? Well, if a firm has earnings before taxes of, say, again, I'll make up these numbers here, $100, and they pay taxes of $20. Okay, so if earnings before taxes of 100 and they actually pay taxes of $20, then the average percentage that they paid in taxes would be how much? Be 20%, right? On the other hand, imagine they made $1 more in taxable income and they had to pay an extra 30 cents in tax. Okay, so imagine they made $1 more in taxable income and they had to pay 30 more cents in taxes. Then what would be the marginal tax rate? Be 30%, right? So you look at this paper. See what's that called? It's called a margin, right? So it's sort of an incremental amount. So the marginal, let's imagine that the marginal corporate tax rate in this example is, say, 40%. Okay, so there we have our numbers, our notation, as well as our numbers. So first question, okay, how much interest does the firm pay every period? Debt of $100, interest rate 10%, $100 times 10%, that's $10, right? Okay, so we got DRD, or $10. So now, because of that interest, that $10, will the firm now pay more taxes or fewer taxes? They'll pay fewer taxes, right? Okay. So how much less in taxes? Or maybe we should put this the other way around first. Suppose that for whatever reason, the firm had $10 of additional taxable income and the tax rate was 40%. Then how much extra would they pay in taxes? $4, right? But in this situation, because of the interest, they have $10 of less taxable income. So how much do they save in taxes? $4, right? So basically, we've got the amount of interest times the tax rate. That's what they're saving. So if we continue with the symbols, DRD was the interest. So now we've got the tax rate times DRD, which is how much they're saving. Now, are they saving that just for one period, or is that already the present value? Well, they're saving that every time they pay $10 in interest, right? So let's assume that a firm has permanent debt, okay? And so if they had permanent debt, it would look something like this, $4 basically of taxes saved forever. And by the way, is permanent debt realistic? I mean, could I go to a bank and say, all right, I'd like to borrow $1 million forever. You think they'd lend me the money? They wouldn't, right? However, what is realistic? How can a company replicate permanent debt? Well, when it's due, could they simply borrow it back again? They could, right? In any case, for the sake of this formula, derivation, it's very, very important to understand assumptions. If we assume permanent debt, then basically this is what the firm would be saving every period in taxes. Now, if I wanted to, could I figure out the present value of all this stuff? In other words, if I bring all these back to time 0 and come up with one equivalent value, could I do that? I could, right? And what is this stream of cash flows called? Equal cash flows between equal time periods forever. What do we call that? It's perpetuity, right? And so if you go to the time value of money lectures, if this formula doesn't make sense to you, you can go through the time value of money lectures and it'll derive it from scratch if you're interested. Okay, so it's basically, the solution is one period earlier, and the C is the cash flow, that's the $4, and the R, well, what discount rate should I use? Well, what element of risk is most closely associated with the taxes? The debt, right? And so what is the discount rate that applied to the debt? That was the required rate of return of debt, or the interest rates. That was 10%, right? And so therefore the debt tax yield is going to be this 4 over 0.1, or $40. In other words, all of these guys put in one single number at time 0 would be the equivalent of $40. And if we look at the formula, okay, this tax rate times the D times RD, that represented the interest. Okay, so all of this on top was the $4, okay? But because it's permanent debt, the two RDs cancel, and we're left with the tax rate times the debt amount. So if you recall, the original debt amount was how much? $100, right? And the marginal tax rate was how much? 40%, right? So 40% times $100 gave us the $40. So that's the debt tax yield given those assumptions. Now, what assumptions have we made? Again, I really emphasize assumptions in formulas because only if you understand the assumptions do you have any kind of reasonable chance of using judgment to bridge theory with practice. Okay, well, number one, debt is permanent, right? Okay. And what else? Well, is this tax yield going to be any good or do us any good if the company's making losses? Does the company get taxed on losses? It doesn't, right? So if there are no losses, there's no taxes to protect them from, at least not for that given year. And so another assumption is that the corporation is actually profitable enough to use the tax deduction. And maybe we could come up with others. For example, maybe down the road the tax rate changes and we're assuming the same identical tax rate. And the fact that we've assumed that debt is permanent, maybe down the road when it comes to refinancing, well, clearly there'll be a different interest rate and so on and so forth. Okay. I mean, just to stress assumptions. Okay. Suppose that for whatever reason the president passed a law that said, all right, okay, you've had this tax break on debt for all these years, and I'll let you have it for another 5 years, and then that's it. No more corporate tax break. I mean, corporate tax rate deduction when it comes to interest. It'll be just like dividends. Okay, you pay your taxes first. So if that were the case, then if we were going to calculate the debt tax yield now, instead of going on forever, you'd only go on for 5 periods. Well, what do we call equal cash flows between equal time periods over a finite period of time? That's an annuity, right? So if we were going to take the present value of all of those guys and put it in one single number, one single time period, specifically time 0, we'd use the annuity formula. And again, if that formula doesn't make sense, then of course you can go to the time value of money lecture and again get all of this from scratch. So in any case, in the case of permanent debt, what is the GL? Remember we said the value of the levered firm was the value of the unlevered firm plus any benefits of leverage, so which is that GL, the gains of leverage. So what is the GL? Well, it's the debt tax yield, right? So if we go back to the Miller-Modigliani assumptions, and they said, all right, no matter what, I'm going to invest in my lemonade stand, and we're going to have all these perfect market assumptions except for one now. Okay? What if we now have corporate taxes? Then this is what it would look like, how important the capital structure decision is. And what is the implication of this? If you want to maximize the value of the firm, then how much debt would a firm choose to have? Would they want to make this guy big or small to make this big? Want to make it big, right? In fact, the ridiculous implication is that the firm would have to take on 100% debt. And obviously that doesn't make sense, right? So if that doesn't make sense, must there be offsetting effects, or must there be other things that are more important than taxes when it comes to the capital structure decision? There must be, right? There must be some offsetting effects. So let's now look at personal taxes, okay? Now, you or I as investors, what do we care about? Do we care about our before tax returns or our after tax returns? Well, presumably we care about what we get in the end, right? So we care about, hey, what's in it for us after everyone else has been paid, including transaction costs to the brokers and taxes to the government, etc., etc. And so basically, what we care about is after any kind of tax returns, okay? That includes both corporate taxes and personal taxes. And so Miller basically had the insight, this guy Miller, that said, you know what, if that's true, if investors care about after all tax returns, then corporations should pay attention, not just to corporate taxes, but also personal taxes. Okay. And so why? Well, because investors are going to pay for their stocks and bonds accordingly on an after all tax return. Now, at the corporate level, we saw debt was happy face or sad face with respect to their tax treatment. They were happy face, right? Because why? Interest was tax deductible. But what about at the personal tax level? Okay. I mean, if you think about it, and I know tax laws change and it's going to be different, from one country to another country, okay? But in the US, the interest income at the personal level is paid at the ordinary income rate, or at least there have been times when that has been the case. And dividends have typically been paid at a low rate, okay? And if nothing else, when it comes to capital gains, all right, if I buy, say, Apple stock at $300 a share, now it's at $400 a share, do I pay any taxes on that $100 of increase? I don't, right? What would I have to do to pay taxes on it? I'd have to sell it, right? So we've had a history where capital gains are not only typically at a lower rate, but if I wanted to, I could just delay it for years and years and years by simply not selling the stock. So when we take all of this together, at the personal level, does it appear that the stockholder is then an advantage or disadvantage relative to debt? At an advantage, right? So if I were going to illustrate my point, okay, I could go debt, equity, I could go corporate tax, and I could go personal tax. Okay, so in other words, at the corporate tax level, debt relative to equity, happy face or sad face? Happy face, right? Because interest is tax deductible. And so therefore equity sad face, right? So we got something like that. But what about the personal tax level? Okay, if you're an equity holder, can you delay? If you have capital gains, can you simply not sell and delay your taxes? You can, right? And even when you do get dividend income, or even when you do pay capital gains, has it generally been at the same rate or at a lower rate than interest income? At a lower rate, right? And so therefore, at the personal level, now the equity holders are happy face, and the debt holders are sad face. So it's kind of opposite, if you will. So in any case, what we'll do now is we're going to calculate the GL when we incorporate both corporate and personal taxes. And so what I'm going to do is I'm going to do this again with both symbols as well as with numbers. And so, here's my corporate tax rate, which I'm just making up these numbers. Say that's 40%. That the PE, P implies personal. Okay, so personal and equity. Notice I've made that smaller than personal on debt. And we're going to begin with earnings before interest and taxes. Imagine that's $100. So in other words, we have an asset investment decision, and for a given period, the asset investment decision produces sales. You subtract a bunch of stuff, and you have EBIT. Okay, so here we have our business. Maybe it's my lemonade stand or whatever. And for the forthcoming year, I'm going to sell lemonade, and I'm going to have to pay my kids to man the lemonade stand, have to buy lemons, etc. I'm going to pay interest. Okay, no, I'm not going to pay interest. Okay, so this is all operational stuff. And then I'm left with earnings before interest and taxes. Okay, so this is for a given period. Okay, and so imagine, I borrow $400, and here's my interest rate, 8%. So here's my approach. Okay, I'm going to start with earnings before interest and taxes for a given period. Okay, now these earnings before interest and taxes, okay, is it fair to say, let me add in one more thing, okay, there's going to be debt holders and there's going to be equity holders. Okay, now is it fair to say that the cash that's produced here, that some of it belongs to the equity holders and some of it to the debt holders? It is, right? And so what we're going to do is we're going to look at, on an after-tax basis, what goes to the debt holders, and on an after-tax basis, what goes to the equity holders. Okay, so I'm going to split up these cash flows into, on an after all taxes, both corporate and personal, what do debt holders get and what do equity holders get. Okay, so that's going to be the next step for a given period. Okay. Now the next thing is it fair to say that some of these cash flows here are going to be related to debt and some unrelated to debt? It is, right? And you'll see what I mean. If that doesn't make sense at this point, as we go through it, you'll see what I mean. And so what that would mean is, when I sort these into debt and undebt related, that would mean for a given period, I'm going to have cash flows that exist because we have debt, and cash flows that exist that have nothing to do with debt. Whether we had debt or not, those cash flows would still exist. Now those are for one given period. Suppose it was the same number every period. To get the present value, then what would I have to do to those cash flows? I'd have to discount them, right? And so that would be the final thing I would do. If I discount anything related to debt, that's going to be my benefit of leverage. So I know that probably is a lot to take in. I just wanted to give you the structure of where we're headed, and I think as we do it, it'll make much more sense. But before I get into it, again, why are we starting this whole analysis with EBIT? Why not start with sales? Well, all of this stuff here, if we began with sales, all of this stuff here above the EBIT, does that relate to the asset investment decision or the financing or capital structure decision? All of this relates to the asset investment decision, right? And we're not focusing on the asset investment decision. So the reason we begin with EBIT is because we are interested in the financing or capital structure decision. So I made up these numbers. These numbers are not consistent with, in this income statement, are not consistent with the numbers we have for this example. So here are the numbers for this example. Okay, so for a given period, EBIT is 100. Say debt is 400, and here are the various tax rates, and here's the required rate of return of debt, or the interest rate. So here I have, for a given period, say $100 in earnings before interest and taxes. So what does the firm have to do now? Well, do they have to pay interest? They do, right? So how would we calculate the interest rate? Well, it'd be the amount of debt times what? Times 8% for a given period, right? And so basically that comes to $32, or we've got DRD. So basically the bondholders are going to get $32. Now, do the bondholders have to pay personal taxes on this 32? They do, right? So what's the personal tax rate for bondholders that I've made up? Well, it's 30%, right? So how would I calculate the taxes that they pay? Well, 32 times 30%, or in this case, $9.60. And so on an after-tax basis, the bondholders would get this 32 minus 960, or 2240. So by the way, what would I do to get straight from 32 to the 2240? What would I multiply the 32 by? Well, 1 minus this tax rate, right? And so if we use symbols, that whole 2240, okay, we could say, well, 400 times the 8%, that was the interest, and then multiply it by 1 minus the tax rate, that's 2240, or this DR times RD, that's the interest for a given period, times 1 minus the personal tax rate. So this is the after-tax cash flow to bondholders. Now let's see what the equity holders get. Okay, so at this point, if I subtract this, that becomes my earnings before taxes. And so what do I have to do now? Well, what does the firm have to do now? Well, they have to pay taxes, right? At what rate are they going to pay taxes? Well, this is a corporation, so they're going to pay the corporate tax rate. So I take the 68 and multiply it by what to see how much they pay in corporate taxes? 40%, right? So now I have $27.20. So if I subtract this, okay, again, to get straight from the 68 to the number we're going to have here, what would I multiply the 68 by? 1 minus the corporate tax rate, right? So this $40.80 is 68 times 1 minus 0.4, or this X minus DRD times 1 minus the corporate tax rate. So that belongs to who? The equity holders, right? Now, do the equity holders, do they have to pay personal taxes if this is the income they get? They do, right? So what would I do this $40.80 to see how much they would pay in taxes? Well, I'd multiply it by this personal equity tax rate that I made up. So if I do that, then I get $8.16. And again, to get straight from here to here, it'd be multiplied by 1 minus the personal tax rate. So now we have the after-tax cash flow to shareholders of being $32.64. Here it's all represented by numbers. Here it's all represented by formulas. And I know that looks kind of, wow, this is this is complicated. But if you think about it, it's really nothing more than an income statement, right? And then figuring out taxes that you get on income. Okay, so the formula looks long and complicated in the end, but if you go through it step by step, it's actually conceptually relatively simple. So we've achieved one of our goals. We've sorted what began with $100 into what belongs to the shareholders on an after-tax basis and what belongs to the bondholders on an after-tax basis. So if we summarize it now with symbols, there's the after-tax cash flow to shareholders, there's the after-tax cash flows to bondholders. And so can I add these up to get the total after-tax cash flows for one period? I could, right? So the total after-tax cash flows, okay, this is what the shareholders get, this is what the bondholders get. And if you recall, what we said was, all right, at this point, we're going to split these cash flows into what two components? Well, anything to do with debt, in other words, anything that's multiplied by the letter D, and anything else that is unrelated to debt or unlevered, right? And so in one given period, if I take this and put it into the two components of anything that's not related to this debt, so X times these guys is here, okay, and then DRD, okay, it's a negative, it is all of this, and a positive here. So essentially, we could say that this guy is related to the unlevered firm, and all of this guy is the benefit of debt, okay, for one given period. Now, why did we sort it out into anything related to debt and anything not related to debt? Well, we want to know what the benefit of debt is. We want to know when there is an existence of D, debt, does it result in a benefit? So these are one period cash flows. What would I need to do if it was the same cash flow every single period forever, like a perpetuity? Then what would I need to do to each of these cash flows to give me a present value? In other words, imagine that I had, say $10 in cash going on every period forever. That's a perpetuity, right? Does there exist a formula where I can say, hey, what is the equivalent of all of these cash flows at time zero? There is, right? And it's basically this guy, the $10, divided by the discount rate. That's the present value of the perpetuity formula. Now, if that doesn't make sense to you, again, you can go back to time value of money, and all of that is derived from scratch there. So given that these are for one period, what I would need to do is divide them by an appropriate discount rate. Now, I don't really care about this guy because that's not what I'm analyzing, so I'll just say RU is the unlevered discount rate. I don't have to put any time and thought into it, okay? But what about on this side? This is the guy that I care about. All of this is related to what? Debt, right? And what factor is most closely tied to the risk inherent in debt? It's the required rate of return on debt, right? Or the interest rate. And if that doesn't completely make sense to you, then I'll go through a quick Q&A, but again, if you go to the corporate finance series, it is made clear when you look at the role of risk and return, etc. But in any case, just to make it clear, imagine that I want to borrow money from you. Okay, I want to borrow $1,000. Well, what interest rate are you going to charge me? Well, suppose I told you I was going to take that $1,000 to Vegas and gamble it. Would you charge me a high or low interest rate? A high interest rate, right? Because I'm going to do something risky with it. But what if I said, hey, I'm going to invest it in a UST bill? Would you charge me a high or low interest rate? Presumably a lower one, right? So in other words, the interest rate is a number that relates to the risk inherent in debt. And so therefore, to get the present value of this guy, we would divide it by the interest rate, except do we want an after-tax or before-tax discount rate? After-tax, right? And so therefore, what we would discount this by would be the RD times, and again, this is putting it on an after-tax basis. So if we put all this together, we said, all right, well, the value of the levered firm is the value without any benefits of debt plus any benefits, if there are benefits. So in our example, when we're bringing in corporate and personal taxes, this represents the VU. We're not really analyzing that. But here is the GL. And we are analyzing that. So if we focus on the GL, we get a lot of this cancels out, right? The RD and the 1 minus TPD, so the RD cancels and some of this cancels out, that would be a 1. And we basically come to this formula. You can look at it and convince yourself that it does boil down to that. So in the end, the benefit of leverage is this formula right here. And so that was a lot to get through, but now we finally get to enjoy the fruits of what this formula is telling us. Okay? Now with perfect market assumptions, what was assumed about taxes? Were there any taxes? There were no taxes, right? So in other words, this guy was 0, and this guy was 0, and this guy was 0. So if all these tax rates are 0, what does GL come to? Well, it'd be 1 minus 0 times 1 minus 0, so that's 1, divided by 1 minus 0, so that's 1. So 1 divided by 1, so all of this would be 1. Then we got 1 minus this 1, which is 0, so the benefit of debt would be what? It'd be 0, right? Which is, that's lucky, right? Because that's basically what Miller-Modigliani showed. What if there are only corporate taxes? What if there are no personal taxes? So this guy's 0 and this guy's 0. So then we get 1 minus 1, but then a minus TC, so double negative. So this just, all of this just results in TC, right? So then the GL would be TC times D, which is what we also derived. That was the present value of the debt tax shield. Now, let's take this a step further. Suppose a stockholder gets $1 in cash on a before tax basis. How much is left after all taxes, including corporate taxes, have been paid? Well, it would be that, right? Let me illustrate my point, okay? So imagine, $1, and then pay 40 cents in taxes, so you get 60 cents. So now that dollar, to go straight from $1 to 60, you could multiply it by 1 minus 0.4. Okay. Now we pay this personal tax rate of 20%, so that's 12 cents. So you're left with 48. So to get from 60 to 48, it's times 1 minus TPE. So $1 basically whittles down to 48 cents in this example, which is the same as multiplying it by this 1 minus TC and 1 minus TPE. What about the bondholder? Okay, if the bondholder gets $1 in cash on a before tax basis, how much is left on an after tax basis? Well, 1 minus that TPD, right? And it's the same thought process, okay? Imagine the bondholder has $1 in interest income. They have to pay 30% tax on it, so they're left with 70 cents. So the dollar times this 1 minus TPD is what they're left over with. So why do I bring that up? Well, imagine that there's no advantage from a tax perspective to being a bondholder versus a stockholder. In other words, if both begin with $1 on a before tax basis, imagine that if what they end up with on an after tax basis is identical. And if that's the case, then if this is equal to that, then what is the benefit of leverage going to be? Well, if all of this is equal to all of that, then this divided by that is 1. And 1 minus 1 is 0. And so the benefit of leverage comes back down to 0. And that's basically what Miller argues. Miller argues that in equilibrium, on an aggregate basis, so if we're confining this, say, to the United States, then companies will continue to issue debt until there is no longer any tax advantage to debt being issued. And he says in equilibrium, that's what's going to happen. And of course, it's a theory, and of course, it's not true because there are assumptions. etc., etc. But it is useful to know about these offsetting effects as we use judgment when we apply it to practice. And so therefore, from his perspective, if we look strictly at the theory, and GL is 0, now that we include both corporate taxes and personal taxes, then what are we saying about debt policy? That this is or is not an important decision. That taxes are or are not relevant to this decision if GL is 0. That it's not, right? And so that's basically, what Miller's model says, that as soon as you add in personal taxes, now we're back to the capital structure decision being irrelevant. So let's criticize his model a little bit, okay? First of all, what does he assume about the ability to take advantage of the interest tax deduction? Well, that they can use it, right? What kind of firm would more likely be able to use this? Is it more likely for a low risk and stable company, or more likely true for a high risk company where sometimes they're making money and sometimes they're losing money, etc.? Well, it's more likely true for a stable, say like an IBM, right? A stable sort of cash cow. But say a Delta Airlines, where sometimes they make a ton of money, sometimes they lose a ton of money, they've already been through a bankruptcy, etc. It's less likely to be true for a higher risk firm. And so here's the question, okay? When making a capital structure decision today, what is relevant, okay? Is it the expected tax benefit, or is it the actual benefit, but you don't really know what the actual benefit is because you're not there yet. Time hasn't passed. You don't know if you're going to make money or lose money in a forthcoming year. And it's the expected tax benefit, right? Because you're making a decision today about the future, so you have to use expectations. So what do I mean by expectations? Well, imagine the probability of realizing the debt tax shield is 50%. And the actual debt tax shield, if you fully realize it, is $100. Then what's the expected benefit of that debt tax shield? What's the probability times 100? It's the 50% times 100, or $50. And again, if that doesn't make complete sense, if you go to the corporate finance theories, we talk about the expectations operator. That's in the lecture on the discount rate for financial securities. So in any case, it's the expected tax benefit that is relevant. Depends upon the probability the firm will have taxable income to shield. What about other factors? What if there's a bunch of other write-offs, like say depreciation? The more other write-offs that exist, does that make it more likely or less likely that the interest write-off will be useful? Make it less likely, right? And what about this? As a firm adds on more debt, okay, and therefore has more interest and more of a shield, does it make it more likely or less likely that the firm will need that shield? Makes it less likely, right? In fact, I mean, you could say, all right, well, just in this particular example, with no debt, obviously there's no debt tax shield, and as you add on more debt, well, yeah, you're getting more debt tax shield, but as you add on too much debt, maybe you've got more tax shield than you need. So in any case, those are some of the criticisms, or if you will, perspectives that you could add to Miller's theory. So if we conclude, we said, well, perfect market assumptions, and assuming that no matter what, I'm going to invest in my lemonade stand, then proposition number 1 with Miller and Modigliani, they said that the capital structure decision did or did not impact firm value. Did not impact firm value, right? And what about stock price? It did or did not impact stock price? Did not impact stock price. Now we add in corporate taxes, just corporate taxes, and the benefit of leverage is this debt tax shield. And so under that scenario, this GL, the gains of leverage, capital structure now is back to being important or unimportant? Important, right? I mean, that's basically saying, hey, you know what? We want a ton of debt. The more debt we have, the higher the value of the firm. Okay? If you recall, again, just to, you can think of the value of the firm as value unlevered plus any benefits of leverage. Okay? So if this GL is this TCD, it's basically saying, hey, the higher the D, the more the value of the firm. But what about a company like IBM? Okay, so assuming IBM is at this point a cash cow and it's always consistently profitable. Okay, does a company like IBM have a high probability of fully realizing its debt tax shield or a low probability? A high probability, right? And yet, if you look at IBM, what kind of rating does it have? What kind of debt rating? Because there's entities like Moody's and Standard & Poor's out there that will rate the riskiness of a company's debt. And it actually has a very safe debt rating. Yeah, I'm assuming, maybe AAA or something like that. And so if it has a very safe debt rating, say AAA, would that, if taxes were the driving force in the capital structure decision, would that be a very expensive luxury for IBM to have? Yeah, because what it would mean is, that if they're at AAA, could they afford to issue more debt and realize more debt tax shield? They could, right? But do they do that? They don't, right? And so that suggests that the debt tax shield is or is not a driving force behind their capital structure decision. It's not, right? So what that means is that there must be more to the story. So then we add in Miller's personal taxes, and he says, well, now that's an offsetting effect, and basically in equilibrium, in the aggregate, firms will continue to issue debt until there's no benefit from a tax perspective over debt. And so he argues that GL goes back to zero. In other words, we're back to debt being unimportant. But if the benefit if that's true, if the benefit for a company like IBM is zero, okay, so IBM, if the GL is zero, okay, so here's a company that can easily fully realize the debt tax shield, but we're saying it's zero for them. Then what about a company that cannot use the debt tax shield? So for example, Borders, that is a book company that went bankrupt. And so if we imagine that it's shortly before bankruptcy for them, okay, then it must be that having any kind of positive debt for them, it must be that GL is negative, okay? So if the benefit of debt for a company like IBM is zero, and IBM can realize the debt tax shield, then it must be negative for a company like Borders. So when Borders has debt, when Borders has any kind of level of debt, okay, then GL is negative for Borders. So what could Borders do to turn that negative GL into a positive? Well, what if instead of saying they had debt, what if we said that instead of borrowing money, they were lending money? In other words, they had negative debt. How could they lend money? Well, they could issue a bunch of equity, and they couldn't. We'll realize that in a later lecture, but in theory, they could issue a bunch of equity and turn around and lend the money out. Well, do you see that happening? You don't, right? And so that doesn't make sense either. And so maybe a middle-of-the-road situation or a middle-of-the-road story is that, all right, when it comes to the capital structure decision, that firms who expect to realize the debt tax shield, maybe there's a modest advantage to having debt. And to firms who do not expect, who have a lower probability of realizing the debt tax shield, maybe there's a modest disadvantage to debt. Okay? In any case, does it look like taxes are the driving force behind a firm's decision when it comes to capital structure? It doesn't, right? It doesn't look like taxes are the driving force. Otherwise, companies like IBM would clearly issue more debt and try to benefit from the debt tax shield. And so what it must mean is that there must be more to the story. And that's what I'll continue with in the next lecture when we look at capital structure and other issues. And again, I hope this has been a great learning experience, and I hope to see you in future lectures. This was James Tompkins, and take care. Bye-bye.